September 13th, the stock market fell pretty harshly, and in this video, I'm going to go over why that happened and some contributing factors. Talk about inflation, the components in the CPI report, which is basically what the Fed uses to kind of gauge where inflation is. We'll also talk a little bit about energy, about fertilizer and crops, and the kind of sentiment in Europe, the UK, and then of course with the current war that's going on in Ukraine. So let's get right to it with the first thing, inflation. So the inflationary CPI index, the CPIU, came out yesterday on September 13th. And pretty much what that report showed us is that inflation from August last year to August this year is up by 8.3%, which is above expectations. Now, inflation going higher is not a good thing. So the market really didn't like that, and it sold off pretty sharply. Now, the expectation was that it would be 8.1%, but it rose by, of course, 8.3%. Many of you may have already seen in the headlines. But why is such a small incremental change signaling such a huge drop? Well, basically what the investors and the sentiment is that the current Fed tools to control inflation are not working. And that is a very, very fearful thing for the stock market, simply because if the Fed's not controlling inflation, then it's not working. What do? It is a period of uncertainty. So in that inflationary report, what were the key components driving up inflation? Well, I wrote them all up. I could have showed you it all on the chart today, but this is more fun. Hopefully it shows up on my screen here. Oh yeah, you can read that. So inflation is up. The Dow was down 3.94%. The S&P was down 4.35%, and the Nasdaq was down 5.16%. I apologize, this is all in reverse as I read it off the screen, my screen, but you guys hopefully are seeing it straight up. If not, I'll flip it in post. So the main things that kind of pushed inflation up were flour, up over 20%. Eggs were up almost 40% from August to August. That's just a 1 year change. And a whole lot of other things if you're baking cakes. Butter, margarine, other dairies like creams and such, because they have cheese. Cheese only went up about 14%, but like all the other dairy products are up 20%. Other things that spiked it was, of course, energy. Energy as a whole was up 23.8%, with fuel up 68%. Energy services, so not only is the energy more expensive, but the cost to bring you energy got more expensive. And then, of course, lower than that, we have health insurance, up an astonishing 24%. That's pretty ridiculous. I have here in the notes that even though health insurance is up 24%, the weighting in the CPI is only 0.88. Now, health insurance premiums can be almost as much as a mortgage payment. So if you are paying for your health insurance yourself, goodness gracious, a 24% increase on your mortgage, could you imagine? All right, and the last thing that pushed up inflation is, I can't even see what that is. Oh yeah, public transport. So if you have to get to work, it's not 21% more expensive. The only relief items, as you can see in the blue relief, if you can read my terrible handwriting, which I am trying to improve, is smartphones down 20% and televisions down almost 19.1. All the things on this list here are the items that were over 20%, which I think is quite high. So that's kind of it for the board. I kind of wanted to use it. I like it. I've had it for over 2 years now. But there we go. And that's kind of how the inflationary picture is. Essentials have gone up tremendously, while more of your fringe items or happy items, lifestyle items like television and smartphone, are down almost 20%. In some cases, like smartphones, over 20%. Now, I say that on the heels of the new iPhone release, but I can assume that most folks who were not able to afford the food increases of 20 to 30 to almost 40% on eggs, probably not going to be buying that smartphone just yet. Or perhaps you're looking for other brands. And when that happens, Apple, which is 20% or so of the Nasdaq and 12 to 14% of the S&P, when that tanks, the whole market will probably crumble, which of course is what we are seeing now as Apple has kind of lost a lot of its strength. But that's not entirely the whole story. It's not only about the US, you see. So energy prices. Energy prices are up here, but they're up even more in Europe and the UK, who are relatively reliant on buying energy from Russia and buying energy or buying crops from Ukraine. And as you know, they're not in the best relational circumstances currently. So what that means is, as we head into winter, which usually has an increase of energy consumption and energy prices, as those things continue to increase more and more, will you see the economy start kind of shifting their purchases away from things that drive economics, things that drive spending, to things that are really, really focused in on essentials. The Fed and how they control, and how all Feds or whoever controls inflation and spending and monetary policy in each of the governments, require people to spend money to stimulate the economy, right? We know that. But as people spend money, goods, if they are in the same supply amount, will increase in price to meet or to at least have some kind of balance of supply and demand. And what's really happening now across the board is the supply of these items that people normally need, like energy, food, fertilizer, all of those things are skyrocketing. And as those things skyrocket, the purchasing power of each individual goes down. Now, the Fed can't inject any more stimulus or money to us. They're not going to do that anymore. And probably now understanding why that probably wasn't the best idea. But then again, they had really no other choice. There really was no other choice other than doing what they had to do to provide stability. Another thing that I guess as a society we could have done was not be so leveraged, meaning we have so much debt where we can't not have a job for more than a month or two and then everything falls apart. So it's not just a government problem, it's not just a people problem, it's just a systemic problem, which we will probably never be able to solve now that we can borrow oodles amounts of money with really no credit or really no ability to pay it back. And the leniency for these people, the banks and credit card companies, that they give you to pay back your loan is incredible. Good and bad, right? So let's forget all that. Actually, don't forget all that. Remember all that for your own purposes, educational purposes. But that's major issues. Inflation going up, supply going down, demand probably going up, right? Because energy prices went down a bit, but they're going to go up again because of winter. And then food supplies are going down because during winter you can't harvest much, and I don't know how the meat side works of it, but I would assume that during the winter time most of the crops are, or most of the feed is going to get more expensive because you still got to feed the animals during the winter time. But both human food and our food's food is going to get more expensive, so therefore push prices of those things even more. Eggs could go up 100%, in a couple months. So with all those things said, it's going to be a rough outlook, coupled with Fed meeting coming up on the 21st of September. They will be discussing how much to increase rates. Now, currently, it's projected that the next rate hike will be 75 basis points. There's about an 88% chance that that was going to be the case before these numbers came out. And remember, the Fed said we're going to focus on the data. So the data is not good. Not good for the economy, not good to control inflation, and not good if you want the interest rates to go down. Because the current way that the Fed regulates interest rates or inflation is by raising the interest rate. So most likely there'll be a 75 basis point hike. Now, many of the Fed governors have said, why don't we just blast it off and just do, 75, 75, 75, October, November, December, and then stop raising it in 2023 and just kind of let it coast. That might be one way to do it. Of course, there's many ways to do what they're doing, and to be honest, it always brings up uncertainty. But that's kind of where the future is looking. And that's why there's so much kind of fear left over. Because there's a lot of uncertainty in the future. Maybe on the 13th of September, we already had priced in a 75 basis point hike for the next 3 months. Maybe that's what happened. And if we get a surprise where they say, oh, it's only 50 basis points, the market will rally up 5%, who knows. But that's all the known knowns, or the known variables that we're looking at. There's still many other things, like China, right? China and Taiwan. We also have elections coming up. We also have potentially new pandemic things brewing. And to top it all off, we are in a bear market. Now you can watch a video that I'll have up about what a bear market is. But to make things simple for everyone watching this video, learning about inflation and all that other stuff, when we have a bear market, that basically means that it's very reactive, very volatile, and news tends to move the market. Bad news or good news, doesn't really matter. And the reason for that is there's less people participating in the market. If you've ever heard of that phrase, sell in May, go away. That's because during June through October, the market's pretty much on a lower volume basis, meaning there's less people participating. And if there's less people participating, that means that we will have wider swings, because if there's no one there, then, or if there's less people there, less people to sell, less liquidity, less people to buy, less liquidity, you have a harder time getting out of positions. And that can be problematic. But that's kind of where we're at. That's kind of why we had such a huge sell-off, in my opinion anyway. Lots of people are probably going to talk, as you've probably watched, as we digest and kind of extrapolate the data that came in today. But I'll tell you from a technical analysis standpoint, as well as from a fundamental standpoint, that our economy is in trouble right now. Policy-wise, we don't really know how to handle this kind of inflation that's spiraling out of control with all the different variables that have attached to it. All the ones that I talked about earlier in the video. Political, geopolitical, all those things are kind of messing up the cohesiveness of what the clear next steps are. And as many of you who are watching this video probably know, probably have enough experience under your belt to know that you can't please everyone. It is impossible to do things to please everyone. So it's all up to whoever controls these things, agendas, or who controls them ultimately. And that's kind of how we're going to have to unravel these next few months as we start trying to get out of this recession. Now, I don't believe that a recession or good economic times should hinder us from what we're supposed to be doing as far as living, working, retired, investing. Right? We should have a plan for all of those things. And that's why, if you're still watching, thank you. This is what you need to kind of frame your investments. So an investment is something that is meant to grow into something else in the future. Now, time horizon has a lot to do with investing. Time horizon means the time you are willing to put your money away, forget about it, till you look at it again and do something with it. Personally, my time horizon for what I do, I'm a day trader / scalper. My time horizon can be 3 minutes, where if I don't see convincing evidence that the price of said security that I am trading is going to hold this price level or drop or go up, then I will exit the trade, or I will exit the trade if I hit my profit target. Most people investing have a year-long time horizon, which means that they can handle ups and downs. Remember that risk tolerance thing that people fill out? Could you withstand a 25% drop in your portfolio? Emotionally, not objectively, because every portfolio can hold a 25% loss. It's possible, objectively. Emotionally, could you handle that? Also, if you are retired or retiring, you need to have all of your essential expenses covered by guarantee income sources, whether that be your Social Security, some kind of pension, some kind of annuity, some kind of, residual income that you may have. Can't be a job and can't be the market, because those two things are not certain. You have to have certain streams of income if you know you're not going to go back to work again, or you know you cannot be working for the rest of your life. Most people aren't going to be working for the rest of their life. I know some people, when you retired, you're going to go part-time. That's fine. But that income that you make from a part-time job should not be used to pay for things like your housing, food, clothes, energy, electricity, utilities, taxes, none of that. All those things should be covered by things that are set. And the reason for that? Obvious, isn't it? Look at the stock market today. Look at the job market. Right? Those two things have failed in the last 2 years. Many people lost their jobs in March of 2020. Many people. Many people this year have lost millions of dollars in the stock market. People probably lost millions of dollars yesterday. And that hurts. But that is acceptable if those losses came from a place that you knew you didn't need. No one needs to go on a vacation. No one needs to go out to eat. No one needs a new TV. No one needs a new car. But you need the essentials. So, what can you do? Well, plan out your budget. It's going to sound boring, simple, but it makes sense. Okay? And do what's right for you. If a financial planner, like me, tells you to invest in the stock market, but you are uncomfortable with any loss, just your budget is stretched out, you need every dollar today until you reach 95 to just make it. Do not invest any money in the stock market, because none of it's guaranteed. None of it. If you invested at the end of 2021, you're down at least 25% on your broader based indices. If you took on risk, you like tech, you're even further in the hole. To get that back may take 2, 3, 4, 5, 6, 7, 8 years. And most people, when they're retired, they need to draw on income, which screws up what's called the sequence of returns. There's a sequence of returns of risk that you have when you're pulling out money from the stock market instead of putting money in. Because when you put money in, you buy low, you buy high. It's generally going to go up, hopefully, right? When you take out money, if you take out money when it's low, to get higher, you need even more money to get it higher. Right? Like averaging up and averaging down. But what I can say is that if you are someone who likes the stock market, likes that kind of risk, now is a really good time to learn. Because in a bear market, the swings are intense. And volatility is a trader's best friend. If I bought something now and it didn't do anything, that's boring. But if I bought something now and it swung up 2, 3, 4, 5%, that's excellent. Today, Tesla, up like 4.5%, 5%. It's a huge move for one day. When you couple that with options trading, You're up like 150%, right? You could be down 100%, just as easy if you pick the wrong side. But it gives you opportunity. Opportunity is a two-sided coin, right? Like everything is. Some have, actually, it's a cube. But opportunity, you can make a lot of money, you can lose a lot of money. Risk reward, that's the coin of opportunity. We have it now. I'm not saying become day traders or scalpers like me. What I'm saying is there's always going to be a negative or positive swing to everything, up or down. And you have to decide whether the stock market's for you or not for you. Stock market's never going to be against you. You are whatever you do in the stock market. You can buy, you can sell. It's up to you. And without commissions and with like super narrow bid and ask spreads, this is the best time to be in financial products, to be in financial markets. But there's a risk. All right, in the next video, I'll go ahead and talk about what a bear market is, what are things that kind of point out a bear market to me, and how I usually like to trade bear markets. See you guys there. Enjoy the rest of your day. Do good things. Bye-bye.